Good evening, everybody. All right. Tonight, again, we have the honor and privilege of having Price Headley here with us. He really doesn't need that much introduction because he's usually on CNBC, Fox News, and Bloomberg quite often. And they usually carry his commentary in the Wall Street Journal, Barron's, Forbes, all the biggies. So Price was actually inducted into the Traders Hall of Fame back. So he's one of your people that has good, solid information, and Price has been around for quite a few years. He's a very good friend of mine, and he's kind of goes in the ilk of he's more interested in teaching you how to understand trading than just giving you the information and hope you can figure it out for yourself. So with that, forum, we're once again anxious to see the info you're giving us tonight.
Well, thank you, Steve, and thank you so much for everybody for being with us tonight. I'm actually not in my usual office setup, so I'm operating off of a laptop here, so I'm going to have to kind of go through quickly, folks, give you a quick overview of what I want to share with you in the PowerPoint, just kind of basic principles of what I would consider to be consistent strategies for success. And you probably love to focus on options, but first, we've got to find the right vehicles to trade. So we're going to walk you through scanning secrets on the market and in particular on major individual stocks. And I'll walk you through how I basically come up with trading ideas. So you can focus on, okay, how do you basically go find those diamonds in the rough, the needles in the haystack, so to speak. It's all about finding that opportunity. Now, I do want to remind you that everything is geared for your information and education only. Nothing, when we go in and look at specific trade setups, nothing should be considered a specific buy or sell recommendation because come tomorrow morning, we could have a gap up, a gap down. This market's all over the place lately. We need to be flexible as traders, and so just consider it kind of a starting point in the analysis. I've found the big trends back in '99. We're coming up on our full 15-year anniversary here next month, so it's been a great 15 years for our Big Trends community. And it's great to be with Steve Bigelow's community here in the Candlestick Forum because we both share a passion for education. So, we're going to educate you tonight. And some of the key points I'm going to focus you on is not just scanning secrets, which is how we led off the topic here, but really focusing on some of these themes like how do you make a more consistent weekly income? These are words I'm having people tell me all the time. I want more consistency in my trading. I'd like to take more income out of the markets. And so let me go back for a second and just share some of the other themes here. So we will get into the scanning secrets, and then we'll also walk through how do you define those trends? How do you define when it's not trending, either kind of a market up, down, or sideways? And then cash flowing options in both volatile times and quiet times. I'll even take a look today at volatility because volatility has really been popping lately. But you know that time is money, and never is that more apparent than in the options markets because basically the more time you buy in an option, the more you have to pay for that option, all of the factors being equal. And so the idea here is that we need to understand that we can at the time. You and I, we probably all share this feeling that time is going and accelerating faster and faster, and it feels like every day goes by faster and faster, and you're like, where did the day go? Well, the beauty of this with option strategies is that it's a 24/7 type of a situation. There's only 24 hours a day in the options market, 7 days a week, and you can benefit from actually starting to capture that time premium we call the time decay and putting time on your side. So the Rolling Stones song kind of comes to mind. Most of us don't feel like time is on our side, but with this strategy, you can actually flip that stanza of time and put time on your side in this case. So we're going to talk about some of these option terms like theta and how you can actually make option time work for you. So quick few charts here, then I want to get into the market scanning because as promised, that's where I know a lot of interest, next great entry. But there's a lot more more that goes into good trading than just finding a good entry. So I'm laying out for you first in the PowerPoint side some of the key options themes. If you've not traded options before, you want to learn these themes. What you'll notice on this chart is, say you're 120 days out here on the left side of the page, and you go over here to ultimately 0 days, which is over here on the right side of the page. And I'm just curious if I've got any kind of a arrow here or option a little bit bolder. It should be visible for you. So basically, we're looking at that and saying, okay, let me make a little highlighter action here. Okay, there we go. So, the key is that I think is interesting is, say that you're looking at the final week of the market's action here. You can essentially see there that if I drew a line across there, and again, I'm just using my pointer here, but essentially that's about 1/4, 1/4 of the total time that you can profit in essentially the last 7 days here, okay? So if you think about that, if you're making over a course of 120 days, that's 4 months, right? That's 16 weeks. You say 1 out of 16 weeks, that's about, what, 6% of the action, almost 7% of the action. You're actually making 25% of the time. Then you can actually start doing this. If you did it every week for 16 weeks, you're going to say that's say you got $4 a time over here, and say every week you're pocketing a buck of time, okay? So say you pocket $100 per contract. That's $1 if you sold that premium. Well, you know what? Over 16 weeks, you'd have 16 points of premium. Compare that to if you just sold the $4 premium up here 4 months away, you're going to make 4 times as much total time premium for selling the weekly options week after week after week. It also gives you a nice way to take advantage not only of time decay, which you can see from the green arrow there is going down the fastest as you get closer and closer to expiration. It'll also allow you to say, you know what, maybe I don't want to be back in a trade on Monday morning after the options go out worthless the prior Friday, and we want them to go out worthless because then you just pocket that premium. So here we're basically selling one option, buying another. And so, the essential idea here is that you're putting the odds in your favor of John Bollinger's Bollinger Bands, I'm sure, right? And I will get to questions later when I can see them here after I go through kind of the PowerPoint. Part of the presentation, but bottom line is that standard deviation is what Bollinger was talking about, and he was saying, if I look at a 2-deviation Bollinger Band, say plotted around a 20-day moving average, that means say over a month of action, you should see price action stay in between those bands. 2 deviations is about 95% of the time on this chart. Negative 2 deviations down to the bottom band, positive 2 deviations up to the top. You see that typically, a higher percentage of the time closer to that moving average, and as you get further away, they should be less and less likely. Now, what I've noticed is that there are times where you can take advantage of the rare moves, but here we're really trying to just put, the power of the probability of these bands in your favor. We don't just look at Bollinger Bands and big trends. We also look at acceleration bands and a whole lot of other tools, which we'll get into when we get into the scans. So the indicators, the patterns, and then also, even though you might find a good stock, you've got to be careful about this thing called implied volatility, because like right now, volatility is getting juiced up. We're going to look at that on the market scans as well. And you said, well, then how do I take advantage of that higher volatility surge that we've had over the last several weeks as the market has actually corrected? So we want to help you take advantage of that too. And so, as we set up these trades, from a strategy point of view, the big mistake that they make a best case assumption.
Price,
you do.
Yeah, Price, can you hear me? Price?
Do some analysis that says, yeah, go ahead.
Price, your volume or your voice is cutting in and out. You might want to check your headset. Yep. No, we've lost your screen also.
Testing the audio again here, Steve. See if you can hear me now.
I can hear you now. Yep.
Okay. I apologize for that. I'm not sure what's happening here, but you know what? I want to spend some time and go into the actual trade station here. So what I'm going to do is let's get into the trade station scanning here, folks. So I think everybody's pretty hungry for that information. So let me see if the monitor will share again here. 1 second. And let's see, it's saying projecting monitor 1. Let's see if that actually works. I'm going to actually try to just project the application because Steve and I were testing that when we were getting started. Let's do that. Let's project TradeStation. That way I can hopefully pick up your questions and make sure I don't lose you like I just did before. Thanks for your patience with me there. And so I'm going to pull up TradeStation. It's working. Let me just actually move that over. Okay, I think we're in business. Okay, so this is TradeStation, and you can use a variety of platforms for active monitoring. By the way, I see my associate Chris Sayers in with us. He can help answer questions as we go. Thanks for being with us, Chris. He does a great job helping me while I'm doing these presentations to answer questions you might have through the chat box. But here's a great example with the S&P. Okay, so we're going to start there. We've got a lot of things that we look at big trends, but when you boil it down, the first thing you've got to define is, are you in a trend or are you in a trading range? And we've got a couple different sets of bands up here. This is actually a Bollinger Band here, this thin light blue line. And so if you look at that, talking about a longer term, I'll even give it to you in the setting, it's an 80-bar Bollinger Band. And that's an interesting tool because when you see how the market's been correcting in the last week, we tagged right down near that lower light blue line there, right back here on, what was that? It's 3 different days now, including today. That was October 2nd. And then yesterday we tagged down near it around 192 and a third. Yesterday's low, 192.36. And then today, yet again, what do we hit? 192.56. And you see the lower band, 192.26. So we're basically within just a fraction of a point on all of these situations here. Now, and I'm glad to see the question box now so I can actually try to incorporate some of your feedback here. So thanks for bearing with me. I'll make sure it's worth your while. Now, this is just an overview of some of the key indicators I look at from 25 years of trading experience. Now, you'll see from the band, we have my acceleration bands, which are these purple bands here. And actually, it would help if I formatted that to a different color here. So let me just change that real quick. On that 200-day moving average there, let's actually make that a white line there because you'll see the 200 days also lurking just underneath for the S&P. So while everybody's wringing their hands about how it looks like the start of a major bear market, I would have to say I would disagree for now. Yes, there's some short-term weakness. We look at things like the directional movement lines, which got weak here and confirmed that back here in late September on the 23rd of September officially. So that was a little bit of short-term negative. But from a longer-term perspective, even though we're getting short-term attempted sells on the percent R when it's going overbought or oversold in this case and staying oversold, we would not actually be very active with that sell signal because when you go back and look at the past times where you had sell signals, look, they happened right near short-term lows because you're still above the long-term trend line. So it's very dangerous to start piling on until we at least break the 200-day. Okay, so that would be a first rule for you that will save you a lot of these short-term potential whipsaws. We're much bigger picture, D, than just using tick charts. We look at more of these big trends over hours, days, and weeks. Okay, so we're swing trading is sort of a sweet spot. We do some day trading with options, and we also do some swing and position trading as well. And so this is a classic simple moving average in the 200-day there. So, okay, that's just the S&P. And by the way, you can see the last swing point low, and you can see I love candles, like Steve does. I'm a big fan of candles, but I do have a belief that any one candle you look at basically needs to be validated. You shouldn't make all of your trading decisions off of one potential candle, in my opinion. I know Steve's got some very interesting techniques he's developed over all his years of trading, and I'm always interested to hear what he has to say about candles and different patterns. But bottom line is that you look at this and you say, okay, this last swing low here was 190.55. Oh, by the way, look at where the 200-day simple average is, 190.55. You think the markets have a pretty good short to intermediate term memory? I would say they do. I would say that a lot of these levels are hitting here because it's very important. Now, does that mean I'm just sticking my neck out and buying at this support point here blindly? And the answer is, of course not. I've got to look at not just the daily chart. I will then take that and I'll swing down into the hourly chart. So we'll look at tools like the hourly, which is kind of choppy right here. We'll even look at the 15-minute chart for the short-term trade, which was moderately bearish coming into the close today. And we look at a lot of other tools there. But I want to talk about scanning here. So what I do within TradeStation is I use this tool they have called Radar Screen. Now, this is something that when you have TradeStation, Radar Screen is a slight little optional stock. So you can see what I'm following here. It's in the neighborhood of about 150. A little more than that now, 161 names, okay? So the idea here is that, okay, when you take those names, you see there's a lot of red on the screen today, not much green, right? In fact, one of the only greens is the volatility index, the VXX. And so I've got those linked up where actually, as I hit this is the volatility ETF. And it's in crunch time mode here, folks. This is why I wanted to point out volatility. You see the VXX was trading a few weeks ago down around 27. Today it hit up to about 32. Yesterday it was up to about almost 33. And that's right up. You see how it's chopping around into that upper band here. If this thing gets through that upper band, that could be a real problem for the markets. But until it does, we have many times where we're not. Today was another one. We went overbought on the percent R, percent range indicator, developed by Larry Williams. I use it in a different way. But bottom line is that, these overbought signals, that's CCI, that's the DMI line, show you that while it's been moving up, had a brief attempted bounce. We've told people, look, this is something that you want to be careful about getting too bullish on volatility. Because look at every time it's tried to give you a surge in the past. About the time it goes overbought, it'll usually stop. See, a lot of what my buy signals are triggered on actually for stocks is when they go overbought and stay overbought. So if you look at a stock, like I know a lot of you have been looking at, probably wishing you'd had a piece. We got a piece of it, the IPO stock, right? So just a quick little percent R primer. When you go overbought and then it keeps going up, so my definition of that is if it closes above that first overbought bar's high, when percent R moves in the top 20% of its range of its readings, then that's around $50. It closes the next day at almost 52. That's a first buy. You can see we didn't have enough data here, so it was actually saying that it was picking up this next one as it broke out one and then two close above and buying the next far's open. But even if you bought there from $68, not bad to $95, right? Then the founders came in and said, we're going to start a charity and sell about 5.5 million shares. The stock got pummeled last Thursday, a week ago from today, on the 2nd of October. We told our students that's a percent R retest, as I call it. That's where percent R is testing just under that overbought threshold. That's a crunch time low, and it went from that low of 79, and over the next few days it bounced back to 98. Now it's settling, but it's near but not quite at a retest. So with the market looking terrible, guess what GoPro looks like? A clear leader compared to the rest. Am I saying that it's early? Of course not, but I'm saying you can define chances to buy the dips within these proven uptrends. Another one that we've liked here, which our scans have picked up, is Green Mountain Coffee. Green Mountain Coffee, the market's down and Green Mountain Coffee is going up. That's called positive relative strength here, not just on the breakout of the bands up here, the breakout of percent R, the breakout of CCI, the ADX line trending up in green. Got a lot of good things happening on that chart. So how do I find these, okay? So let's go back here and look at Radar Screen. And it's all about time frames. So what I always recommend is you start with the big picture first and then you move on over to the shorter term, okay? So always start longer term and then move to shorter term. So I've got it set for intraday because I use that to look for day trades on the 15-minute chart. But for daily chart followers, I would start there and say, look, if you're just looking at a daily chart, this gives us more of a tabular data view, and you see it's taking a moment to recalculate for monitor setup. It calculates almost instantaneously. But what we're looking at is, as it recalcs those numbers, we can go in and look at things like percent R and say, show me something that's gone bullish or bearish. So bullish to me is where it goes overbought and then it keeps going up. So I can flip that around and say, well, then show me what's really strong here. And surprisingly, you see the two stocks that went green in the last couple of sessions would be CF Industries, ticker symbol CF, even though it pulled back a little bit here today. And what else? It looks like we might be waiting on a couple data pieces. Bank America, BAC, and also green was bonds, TLT. So bonds are actually in a buy mode. So let's talk about bonds for a second. So you can trade bonds even in your stock account. That's kind of ironic, right? With just the 20-plus year bond ETF. And so, one of the things we were pointing out to our students as this fear started to build in the last couple of weeks is that you can see that bonds have started to pick up, and you could even look at them for quick trades. Where here's a great example. Back here on what was that, Tuesday. When we gap up Tuesday morning when the market's popping down, you see percent R is going up to the top of its range. You would think that something at the top of its range, but that high, 118.41, was taken out the next 15-minute bar at 118.46. That's actually a bullish signal, and that's why it's giving us the buy on the next bar's open here. Then when it comes back and tests under that overbought threshold, we call that a retest. So I'm giving you some primers here on the percent R rule. It's the big trends way, where overbought can actually be a very bullish thing when you know what you're looking for. Okay, so this is the TLT. And so, for example, if you were then saying, look, even when you're getting a retest here at about 118, I wouldn't say buy the 118 call, because that's pretty aggressive. You could do that, but what I would actually be thinking is, what if you sold a put, like the 118 put? What's the difference? We would also buy probably like a 117 put. We actually did in our rapid options income service as this TLT started to improve here a couple days ago. But bottom line is, let's just look at the option chart for a second. This is pretty cool. So remember, if you're bullish on TLT, you want it to go up. But let's just say that you also just are saying it's probably not going to go down. It's going to either go up or it might chop around and go flat. Well, one interesting strategy is you could actually sell a put like a 118 put. So let's just type that in for a second. Remember the same line here that we've got on this chart back early on the morning of the 7th. So it's going to show that same line when we change over to the put. Say, you know what, I don't know why it didn't come up. Let's get my symbol right. It's a 1010. This is the weekly option that we were looking at. Say you were looking at, maybe it's working offline on me here. That might be why it's acting up a little bit. 1 second. So let's try again here. That might be part of my problem there. Okay, so when you're looking at the bond market, I'm just going to pop picks here on us first. Let's go back to TLT. Okay, got a bad tick. That's the point at which I was just talking about. That option was trading at about $48 a contract right there on 1045. And you can see the rest of the day it went down from about $48 down to about $18. So it got cut in half. Now, in comparison, obviously in this case, if you were buying the calls, you would have made more money. We wouldn't do it because it's just a little too aggressive. But you actually, in that case, when you get that powerful of a trend signal, it was breaking out here, then testing back at about 69 cents. You see that option went from 69 cents to $1.50. So that more than doubled for an at-the-money call. To me, that would be too aggressive. I would have been looking at something more conservative, like an in-the-money option, the 117 call if I was going to buy. The same leverage, you'd see the difference here is, there it is, retesting there at $1.50, and that one goes to about 240. So you say, oh, I only made 90 cents on the $1.50, but the difference is, remember, if you're buying a 117 call here and TLT is a little over 118, your risk is the time portion of the trade. If you buy the 118 and it's at 118, you're risking all of your option as time premium right there. So that's very risky. it's 23 cents in the money on a 118 strike, 118.23. If you bought the 117, it's $1.23 in the money, and you saw you were paying about $1.50. So you really change your dynamics of how much risk you're taking to buy the in the money, or if you sell the out of the money when you're doing the credit spreads that I was sharing with you earlier. And so from this perspective, and if this is new to you, bear with me, okay? We're going to spend some more time going through some other examples here, because I don't have time in an hour or about a half hour left to go through all these different indicators, but let's just focus on %R for a minute, okay? So if we say, okay, you know what, that's all fine and good. Now let's go back to radar screen and get our updated chart. That's why it wasn't updating, right? So now that we're logged in, now you see, look at what's strong here. Yes, SDS is the strongest. That's the S&P, because it moves inversely to the market. But look at this one. That's kind of interesting that ICE, Intercontinental Exchange, gave a bull confirmation here on the daily chart. That surprises me that anything, given that the market was down, what, about 300 points on the Dow at one point today, that anything would be bullish. So you'd say, well, I need to take a look at that. It doesn't mean that I want to go just buy a bunch of calls, but it means that I want to be aware of what's happening. So it's saying that, yes, ICE broke out the day before. That high was 201, and today it closed at 203. So this stock was up when the market was down. Now remember, ICE started as an energy derivatives exchange, and then they actually made an offer to buy. Kind of interesting that, if you're bearish on the market's basically telling you, you know what, we're kind of bullish here on the way that stocks and these overall exchanges are positioned, and so that's surprising, but might give you a clue. You see, ICE has been kind of dead money for a while, but it might just be perking up here. So that goes on to my bullish watch list as a leader. And then remember, I was just Mountain Coffee, not just because I like coffee, right? I mean, coffee is important. It definitely keeps the world going around. It seems like more and more these days. But also, when you go and you look at and of course, Green Mountain makes the Keurig machines, right? That the single serving is their play compared to, say, Starbucks, which now has a little bit of that business too. But Green Mountain and Keurig was there first. But you look at that and you say, well, there's Green Mountain yesterday on %R. What that means, yellow means it went overbought in the top 20% of its readings. I actually use a 0 to positive 100% scale because I find the grade school scale, I guess I'm just used to it from back in the day. You want to score 100 on that test. You want to get an A+. Same thing here. You prefer stocks in their mid to high 90s from a standpoint of that they're at the top of their range, that they're leaders. You think, well, hold on. If it's at the top of its range, why would I buy it? Because when you look back over time, and we're going to look at a couple right now, just again, to give you a quick little history lesson, you look at Apple. You say, okay, Apple had the news today about that, they were coming out with their special event on their iPads or whatever, got an initial pop and then kind of faded a little bit. Outperformed the market. It was not down much when the market got whacked, right? But what we're saying here is when Apple really broke out on the earnings gap, we don't like to putting your portfolio at too much risk. You might like to swing for the occasional home run that way. I don't like to do that because if you're on the wrong side of that, you get a big strikeout. You get a situation where you can't manage your risk properly. So, when I look at this situation, let's take a closer look at that real quick. So, like when it broke out on the earnings back here, you see how the %R surged up to the top end of its range because naturally it's gapping way up to the high end of the range. And you see that the high of that day back April 24th was $81.43, adjusted for the 7-for-1 split. And you see it closed above there the next day. So it's telling us, therefore, to buy that following bars open. We test everything based on if you did your scans at night on a daily chart, you wouldn't be able to get into the next bars open. So we basically focus on that. Now, you can also see I've got my acceleration bands here in purple. I've got the longer-term Bollingers in light blue. We've got the %R. We've got the CCI, Commodity Channel Index, in yellow. And we've got the ADX here in green starting to move up off of a low level. So all those things together telling us this is an outside of the bands kind of a positive catalyst situation. And you know what? I told people to buy it there, and if you missed it there, I told them, well, then if you missed it, you should wait. Because you see, that day alone, it went from 81.83 at the open to close about $85. That was a pretty good percentage move, especially factoring in when it was 7 times higher. It was like a 25-point move that day. And I said, if you missed it, then be patient, wait. And what do you wait for? You wait for what I call the retest. When it tests back under that overbought threshold, you see, percent R is kind of a jagged line, even with the settings we prefer to use. And so when you get that little jagged pullback, that's where other traders, you've been here, haven't you? You're getting flushed out of a trade that you really like, but you're just getting knocked out intraday by your stop loss discipline. You're getting your stop tagged. And then you ever see that happen? You're stop tagged, and then the market turns and flips back in the direction where you were betting in the first place, but you're now on the sidelines, on the outside looking in. I don't think there's anything more frustrating in trading. Sure, nobody wants to lose in the first place. That's important to control risk. But what I tell my students is, you know what? If you miss a breakout, you can always wait for the retest and find a fairly low-risk entry area. So I told my trading workshop students to buy it there on that day. That was pulling right back into that retest on that Friday morning, the 9th. I said, okay, this is a great chance if you missed it. And what we did is we did a debit spread in that case. We bought an in-the-money call, the equivalent of the 80 strike call, and we sold an out-of-the-money call, basically equivalent of where it was having resistance before, up here around $85 to $86. And you see what happened. It snapped up pretty quickly. Notice if it doesn't break that low, it's not a violation if it pulls back and retests underneath that overbought threshold. In this case, when it finally did have another test, 91.90, it closed below that the next day there at 91.28. So from that perspective, and let's zoom it in a little bit now to the recent action. You see, where's Apple been more recently? It's been in what I call more of a no man's land. You see, 3 times when it color codes like it's red, like that might be a problem. Actually, it's a good thing if it goes overbought and stays overbought. Even though this close was higher than the last setup, that wasn't a valid percent R buy to me because it was a new, every time it goes back under overbought without confirming, it then sets up again. So that's another setup. Didn't close above it, you stay away. Then it went oversold on the slam down there on September 25th, and I think that might have been where the stock was getting knocked, not just with the market, but maybe on that bend gate of their iPhone 6 bending. Some worries about that turned out to be probably overblown, I would imagine. But bottom line is, this stock is in what we call a no man's land. It's stuck between the 20 and 80 thresholds. Now here's the lesson on no man's land, folks. If you trade a situation like this in options, you're basically asking for trouble if you buy an option here because it is not moving fast enough to overcome the loss of time. Even if you bought it well there, on the 25th, and you said, well, what if I bought, say, an 98 call, at the money call? Let's just look at that for a second. If you bought the 98 call, you might make a little bit of money, but that's like picking out the one spot on the chart where maybe you might be, buying it just perfectly. But even that one doesn't look that juicy to me because, look, you buy it here at the perfect spot at 235, and while you're right a little bit at first, unless you know exactly where to get out at the exact highs, about a 50% pop up. And if you know how to pick every high and low, you probably don't need to be here. You need to be on your own boat on your own private island, right? Because the reality is you're never going to get things perfectly right. The problem there is that as you're at 235 and then you see it start breaking here at $1.90, you might even panic and say, you know what, even though the stock's not making a new low, this option is because it's just moving too slow. And then you see, yeah, it popped up yesterday and a little bit this morning and then came back down. So let's just say you held it to the close today. So yeah, you'd be up, in that case, almost 50%. But the reality is, if you got it wrong and you were trading the put in comparison over that period, say the 98 put, let's pull that data up. Well, you can see, say you're getting bearish as the stock popped down on that news. You can see those options went from 240 to finish today at 41 cents, down 5/6 or 83%. So the thought here is, that. I don't like the odds of, making 50 or losing 83. That means that over time, the time sellers are winning on Apple in that case. Now, the other chart I want to show you a quick percent R lesson on, as well as a acceleration bands lesson on, is Tesla. I know a lot of people follow Tesla now. I was talking about Tesla last spring, stock was breaking out. Oh. So you see, even the start of this year, I mean, had a beautiful breakout here where it goes over bought here in January. You can see then it closes above that high. So the idea here is that, when we see these things happening, that tells you, okay, sets up at that high, 162, closes above it, 164. Boom. That's the start of an uptrend. Now, if you miss that first run to about 182, here again, wait for the retest. The retest happens back at 164.71. I tell my students, you know what, you can buy that dip because if you're wrong, then a close under 164.71 is going to get you out. Now, that's the key word there, a close under 164.71. Don't let an intraday trade knock you out. Here's an example. There's a couple where, this one was another retest here at 169. By the way, every successive retest, this was close to a retest right there and also right there. And if you saw that happening around 80 right here, the next morning, this is what I call the bend but don't break pattern. Let's say you got your retest around 242.5, and then the next morning it opens down at 237. You say, uh-oh, I'm on the wrong side. I better get out. Or if you're putting your stops in intraday in this case, you're going to get whipsawed. Now you see what happens. It opens and flushes those stops out in the morning, and then boom, it shoots right back up by the close. We call that a bend but not break because the key number was 242.55, the February 28th low on the retest, and then it did not close below there. So you see, you're able to then get out as it pops back up to 260 or so, and then it retests again, and then it does violate in here. So it goes from a new low down there at 236 and tells you then broken at 234. But the point is, at least you had a chance to get out up here when it snapped back up rather than getting flushed like everybody else on the morning gap down that just shakes out some stops. Okay, back to scans for a second. So market scanning secrets 101 here. We went through some of the daily charts on the bull side. What about the bear side? What we'll see is probably a lot more bears. Look at that. These stocks are all finishing in the 0, 1%, 2%. That means they're closing the bottom 1 or 2% of their recent last, in this case, about 6 weeks of a range. Going bear confirmed. Now, when we go and look, I would prefer to see them below 20 on the day before, and a lot of these weren't. But you can see a few of these that were, like FCX. That's the Freeport, McMoran, copper, and gold. You see a lot of them yesterday because of the market bounce. The market's been so manic depressive. It's been down for a couple of days and snapping up hard, then down hard. It's kind of trying to decide which way it wants to go. But these are the kind of ones I look for. Like that's USO. Let's talk about oil prices for a second because that's USO. And if you look at USO, you'll see that that's not exactly the first sell signal we've had. And this should be very bullish for stocks eventually here if you look at what's going on here with oil prices. This is the oil price ETF, USO. Now look at what's been going on for oil prices for about the last 4 or 5 months, really 4 months. So you say, look, official top, June 20th. You think, well, that makes sense because, you got the summer driving season, right? So usually the prices go up in front of that. But, it's really interesting to me is how oil prices are cratering. They're coming down hard. You see it at the pump, although, by the way, with the big shot down you saw today and even the last few days, you're not going to see oil prices go down the next morning like you see them go up. If oil prices spike up like right here back on the 12th of June, I guarantee you that the next day on the 13th in the morning, you're going to see the price at the pump jump up almost in correlation with the percentage move that the oil price has moved up. So they are very quick to pass the price increase to you and I as consumers, but they're very slow to pass the price benefit on the decrease in oil prices to us. So you can't make that same assumption that oil prices are going to plummet tomorrow morning or gas prices will plummet tomorrow morning. But I can tell you, in addition to ways you can make money on buying oil when it's going up, you can also get to the pump in that case, that night when you saw it's going up because you know the next morning it's going to be up. In case you're in that neighborhood, I mean, shouldn't drop everything to do that, but it's a good reminder when you say, oh, yeah, cars are running low, not a bad time to fill up my car or my wife's car, in addition to getting a piece of that uptrend while it's lasting. But right now, we're in downtrend status. You can see we had a big, strong steady oversold downtrend that lasted most of August. Got that retest coming in, and this is a bearish case. So in the bottom 20% of readings, then it breaks below that. In this case, it was also just about to break the 200-day here. That's a confirmation. Then when it bounces, there's your retest. A lot of times they're sharp 1 or 2 day kind of bounces. That high was your resistance, 35.83. We snapped down right away, right after the Labor Day holiday, September 2nd. There's another retest. So if you miss that first snap down, the next day, this is a way you can make the market's manic depressive tendencies play out for you. And yes, Nancy, you can do this on other platforms like Thinkorswim. Thinkorswim is one of our auto trading brokers for our rapid options income credit spread service, among our other recommendation services, as is Trade Monster. And we're about to add another one that we'll announce to our Big Trends community soon. But basically, in the meantime, and you can see, in the meantime, you may also have times where, you know what, you get stopped because it retests, and then it pops up through that high. Then you got to hop out. Then it's in that no man's land, low into the range, high into the range, nothing clear yet, and then we set up again, and then we break down about 3 days ago. So when you really zoom it in, you say, wow, well, this told us to get back on the bearish horse here. There on the morning of October 6th, we were at 33.77. So normally, if you're bearish, you might think of buying something like, say, the October 18th 35 put, something in the money. From that point, you'd say, you know what? From that point, that option closed at $1.34. Today, it finished at $2.93. So it's doubled plus in 3 trading days, right? So that's attractive. Another thing that I tell my students to consider doing is consider selling the put. So, in this case, we would never sell a naked put. We might sell a 33 put, which you can see. I'm sorry, that's the put. We need to sell the call. We bought a put, we sell the call. So in a bearish case, because a lot of times in this bull market, we've been selling puts and buying a cheaper put below that to protect ourselves. But in the case of you find a bearish trend, in this case, the 10.18 C for call, we might look at, say, in the 34 call, it's a little bit out of the money. So it's not going to be a ton of premium there probably. But you see, it finished a few days ago at 65 cents, and today, look at that, last trade 4 cents. So with the credit spread strategy, when these things expire worthless, you don't have a commission on the way out. Typically what we might do is, like, you might sell a 34 call here, and you might buy the 35 call to protect yourself. So what that means is that you sell this one at the close here at 65 cents when you get that SO, and then you might buy the 10.18 C for call at 35. So that one might cost us at the close 23 cents. So 65 cents we collect, but we have to pay 23 cents. Now, what does that do? Real world example there, because you're saying, look, what that does on the close on the 6th is it locks you in at your worst case risk is the 1 point differential. If you sell a 34 call and you buy a 35 call, you're basically saying, okay, I'm taking on the risk from 34 to 35. But for that risk, you're actually collecting, what, 65 cents minus the 23 you have to pay for the, we call this our insurance on the 35 call. This limits your effective max risk to the 1 point minus the credit you collected, which was what, 65 minus 23 is 32 cents. That means that you'd be making $32 per contract on this spread, and you'd be risking a point minus the $32, or 100 minus 32 would be $68. In this case, you'd be positioning to make almost a 50% return on margin. That's a little bit aggressive for our standards. Usually with our rapid options income portfolio, we're looking more at probably 25 to 35% return on margin for a week's work. These are the weekly options that we're usually looking at. In this case, this is a monthly option that's got about a week and a day till next Friday's expiration. Now let's go back for a second to radar screen. I've shared with you how we start coming up with ideas, and what would catch my eye would be something that's going way overbought, or in this case, way oversold. And, even some of these financial stocks like MetLife, there's another one down here because it stayed under that 20 percentile level. Some of these other ones, when they went red back above 20 without confirming, that wasn't quite what I wanted to see. So, I could look at a MetLife as another example of financial stocks. Could be right down below the 200-day. It's actually already been on a sell. There's one retest, and there's another just happened yesterday at the highs, 51.99. We tested right into that 20 percentile level and then see how nastily it snapped down from that 52 area down to close at 50.35. If you missed it, you might wait for the next retest when it comes back into that 20% threshold on %R. Now let's talk intraday for a second, because I know there's probably a lot of you here who are day traders or swing traders. So what I do is I move down from the daily chart, another key swing trading secret. Start with the big picture and then work your way down. So we'll format it from a daily chart to an intraday chart, and I don't like a 5-minute bar. I think that's too short. You're going to noise yourself out far too much. I'll go from a daily to an hourly and then an hourly to a 15-minute. So we're recalculating here now that it is indeed connected online. I don't know how to disconnect it before on me. We're probably not going to see a whole lot of bull signals here, right? You got one, and that's that bearish ETF, right, SDS. Some of these that are staying above 80 right now, like Green Mountain Coffee, are interesting. Oh, by the way, there's gold. So while gold looks horrific on a daily chart, it's actually showing some signs of staying overbought here on the hourly chart. Now, I'd be a little cautious about that because you want to make sure you line up all of your time frames. So it is bullish on the daily. Notice it's not getting through that upper Bollinger Band. It's also really not bullish on the daily. It's still more net bearish. So that's the kind of thing where it pays to look at multiple time frames and be aware that the daily is not going to support you on gold GLD. But, then really what you'd be looking for right now in the very short term, of course, is the bearish trends. So we'd flip this over to the bear scan side, and we go say, well, show us what's really going bear confirmed in the bottom 20% or less of its readings. And you see a lot of them down at ARCP, DGX, Cree Research. First Solar I was looking at this morning, you see that one really collapsed from this morning's pullback the rest of the day. And what happened, it stayed at the 0%, the 0.5%, the 0%. That means it's closing right near the lows. So let's look at First Solar, FSLR, for a second. And you'll see, okay, the daily chart was already bear confirmed. It was confirmed bearish. So that's good. You want to see your big picture trend confirmed. Then you go look for your short-term trend to back it up, and there you go. Your hourly chart was bear confirmed here at about the start of the bar on 12:30 at about 59.5. And then you would go down and also take a peek at your 15-minute chart, and guess what? It too was bear confirmed. We call this triple confirmed. Daily, hourly, and 15-minute were all bear confirmed. More downside momentum to go. So again, if you were looking at, the stock's trading about 58.80 at the time, so the aggressive option buyer is going to be thinking, well, maybe I could trade the October 60 puts, a little bit in the money. They've got about $1.20 a ton of intrinsic value, and you see today we're getting that signal we set around 12:15, 12:30. They're trading about $3. Now you see that's a little bit rich, because that option only had about 7 days of time left before next Friday's expiration as of this morning. So at about $1.20 in the money and you're paying $3, that doesn't appeal to me very much. What appeals to me more is selling the that case. I say, you know what, the 60 calls probably got a lot more time premium. It is headed into earnings season, folks, so one of the things you need to double check is your earnings dates. Make sure you're not stepping in front of something and selling premium on something right in front of earnings. You see in this case, they're around 12:15. The call was trading about $1.30, and it finished 80 cents by 90 cents. So, yeah, it would have made you in the neighborhood of about $40 a contract from $1.30 to about 90 cents if you were buying it back. But this one still has that very oversold momentum on the option sale of a call. It's because the stock has the big down momentum on all three time frames. Okay, now I'm going to try to pick up some questions too, because I know some of you are probably trying to, really, if you're new to this, I'm probably going a little too fast, and for that I apologize. But I know there's a lot who have already heard me before, and so I'm always trying to give something, whether it's to the big trends method and to trading in general. So let's talk for a second about, okay, so you come up with an idea like First Solar. A big part of what we're looking for then is you're then looking for, okay, what's the amount of cushion, the amount of room you can give yourself to give yourself that wiggle room. You say, well, we're getting the sell signal even on the 15-minute chart it's about 58.80, and you say if I go up to 60, that gives me in the neighborhood of about 2%. You know, that's not a ton of room for 6 days left, and so this is something where you need to then go and look at your various choices, and you might say, you know what, when I look at that choice, I might just say it's not enough room. So it might even send me back to the drawing board and say, you know what else is out there? So sometimes you'll see names out there like McDonald's. You say, McDonald's? Who would want to sell McDonald's? McDonald's isn't as a cash cow, right? Everything working for it when I look across all my key scans. But you know what? That lower band's not as weak as I would want. This is another scan I can do. I can go say, show me it's really down below its lower band. Those are going to be your weakest stocks. There's where First Solar made the number 4 on the list, even at the close today. The other thing you notice is a lot of oil. That's Williams Company. That's Walter Energy. That's Chesapeake. That's APC. That you know, you go through the Williams, WLT, APC, Chesapeake. So you're saying, look, if I pop those up real quick, APC and Chesapeake, for example, say, wow, oil's been on a sell there too on APC, Anadarko, going back a few weeks. And you say, well, yep, but it kicked you off for another fresh signal today, and even the 15-minute chart was there this morning as well. So if you're looking at Anadarko this morning, you're saying, you know what, okay, 95 level was the resistance this morning. So right down here when it's giving me the sell, if I was looking to sell, just out of curiosity, the 95 call, could I get much premium for that? A little bit. You'd collect about $1.09 when we got that official sell signal, and that's about 2.5 points above the market. That's not bad. Okay? Now, what we'd probably be looking at in comparison is say 2.5 points above that. Say we bought, and we'll even see if they've got a 1-point strike first. They may not on this one, but basically, let me copy it in case they don't. So they do. So $1.09. Okay, that one was also trading at about 90 cents on that one. That's the terrible spread. That's only like 19 cents in my view. That's just not good enough. What about a 97.5? Just out of curiosity. They do have that because it's the monthly options. That thing is trading for about, let's see, that's today. We were just talking about it. Where was it? It was trading about 60 cents. So $1.09, 60 cents, you make 59 cents on 2.5. What that means, but that's on 2.5, which means you actually have 59 cents less. That's like a $1.91. So you make 59 cents on a $1.91. That's almost 33%. About a 30% return on your margin. That's not bad, but it's just something that you pay attention to and see if that's something that interests you. But that's the kind of name I'd be looking at and saying, you know what, okay, so energy's weak. You know, the other ones you'd compare it to because you're like, well, you know, I'm looking at energy. We've already talked USO. You notice any themes coming up here? You see the themes develop on which sectors you want to be considering when all the stocks are selling or all the stocks are buying in that sector. It's a momentum thing, folks. The institutions start piling in or they start piling out, and your job is to be in tune with that. And I got started a little bit late because of my tech problems, so I do want to say, hey, bear with me because I want to share with you first here before we're done. Okay, so from this perspective, let me, I know we had a little issue with the fit to screen. Let's just see if I can possibly get it to share there. Let's show you one more example, and then I'll mention something that you can really take advantage of here. Okay, so you're looking at premium selling. You're saying, okay, if you remember, we just talked about that VXX chart, and I think we might have looked at it before it had actually logged back in. So let's look at it again. So you look at the volatility chart right here, and we're at 32.25, okay? And I mentioned how, yeah, we're right back up near that upper Bollinger Band. 1, 2, 3, and we almost touched it again today. That upper band's about 32.5. So a trade that I'm watching really closely right now, we say, you know what, if we're looking at this, we're saying, okay, we'd like to go take a peek at Okay, we're 32.40. I know that number, we should hold that resistance at, which is 32.65. So what I could do is I could sell, and I could be conservative here and say, you know what, in case this market gets a little wacky intraday, I might want to not just sell the 32.5 or the 33. I might want to sell the 34 strike calls. So, for example, if you sold the 34 strike calls, you say, look, we're overbought, but yet again, we're not confirming. And the idea here would be, look, we do this, we type in the 1018. These are the sweet spot options that I like to consider right here. And this is not a specific recommendation, but it is something that I'd be looking at and saying, okay, you know what, we're right up into some potential resistance here. So you say, okay, so what would I get for this? If I sold the 34 strike call, you could collect $1.07 on the bid. That's $107 per contract. But I need to protect myself, so what I would consider is, what's it cost me to go buy either 1 or 2 points above that? So in this case, it's not very good just going 1 point above it because the spreads are a little wide. So you see, I've got to pay a 7-cent spread on each side. So if I get $1.07 and then on this other side I get 91 cents I got to pay to buy it at the ask, that's the worst case pricing. I'm only collecting 16 cents net. So I might even go out and look a little further and say, well, what if I was buying the 36 call to protect myself? Well, in that case, it's still a wide spread, 67 by 74. So, but you see there was good volume on the 1,030 contracts today on those. And so what I'd probably do is work this in the middle. I'd probably try to say, you know what, if the middle of this is about 70.5 cents, if I buy it around 71 or even 72, and the other one we were just looking at, you know, if I can sell that for say $1.10 just below the middle, which is about $1.10.5, $1.11. You say, look, if I can get $1.10 and 72 on the other side, that's basically saying, okay, you know what, we're right at the 38-cent level. So just for a round number, call it 40 cents for a second. It's a 2-point spread, and if you collect $40 a contract, that means that you would be risking not the 2 points or $200 a contract. You'd actually be risking 200 minus the premium you collect, so you'd be risking 160. So that's only making 40 on 160. That's only a 25% return on margin for about 6 days of work. I'd have to say that's not enough in this case. I'd probably be looking for something more like a 33% return on margin for how volatile the market can be and VIX can be. But I do think it's going to be very interesting to see what happens to the VXX here, especially tomorrow. Going into a weekend, you've really got a situation in which you really look at, okay, what's going on here? And you say, okay, I really would be focused on, it's crunch time that's overhead. If it does what I expect it to do into next week, despite all the fear that you've seen building, odds are that this thing's going to probably hold as resistance and we come back to 30 or even less if we break the back of that fear. Now, if I'm wrong and we close above that band, which is 32.65, then I'd say back off of any of that potential stopping point view because we'd lose that resistance, even though the acceleration band in purple here is about 33.26. That's what I'm saying. I layer my strikes that I sell above those bands of resistance. Okay. Now, we watch all volatilities. We watch all these key elements. And so, basic premise is, okay, so we've covered a lot of ground here in a fairly short order. And what I've really said, to start with is percent R. So percent R will be a good guide for you to say, you know what, is something going to be stuck in the middle of that range? If you go back and look at volatility, for example, the times where volatility is oversold, look at what happens to the market. If you go back and compare this chart, when the VXX went oversold back here in April 21st, all the way through until it finally ended here about mid-July. Guess what the market did while volatility was dropping like that? From April 21st, it actually gave you an early warning signal of the coming buy signal we had on the market in mid-May. So it was telling you early that the market was going to be losing fear and thus it was going to be rallying. Since then, what's the market done? A whole bunch of nothing, right? Volatility, in the meantime, you saw even when it tried to give another sell here, it really never went down. It just flatlined. So I was telling you that sell signal in volatility was not a good one. Wasn't a really bad one either. Just went nowhere, but the point is what that meant was we don't have that kind of a steady decline of fear. Now it's saying we try to give a couple of rises in fear on those little attempted, and we'll see what happens. I don't want to see it closed over this 32.5 level. That's going to be the key for volatility. That really holds the keys to the car, if you will, and to the kingdom based on who's going to control this market over the coming weeks, tied into this volatility test right here. Because if we get through it, watch out. The last time we really got through it, I don't even have that data up here. Let's just get some more data. If we go back and look, say, 5 years back, real quick, you can see we could talk charts all night. But bottom line is that the last time it really got going like that was August of 2011. And in that period, guess what happened to the market? Not good things. The S&P dropped like a stone. Go back to that real quick. There it is. That same period when VIX gave that buy signal that was truly confirmed, the S&P dropped from to 110 in a week. Okay, so that's what I'm saying. I'm not going to do that VXX credit spread if I've got a risk of a big move against me in a short period of time. So let's see what happens tomorrow morning if the market wants to follow through, if VXX starts really surging. That would be a bad sign for the market. We could then see a big drop. But for now, the odds are favoring that that's resistance. And so you've got to trade what you see, folks. You can't just trade what you believe. You might believe we're going to have another one of these big sell-offs, but it might not happen. And so the bottom line is you don't want to get stuck on that. Okay, I've now gone over my hour. I don't want to keep Steve and his team, Becky, and all the good folks at Candlestick Forum with us too long. Rick, appreciate you all being here with us. But bottom line is, let me just share with folks real quickly, and then I'll answer a few questions just to kind of wrap up. But share with you a special that if you are finding you need more education, a big part of it is to educate traders like yourselves on exactly what's the right way to trade here. So let me just share with you real quick. Let me just share my, let's see if it'll share my monitor for a second. That wasn't working right before. Let's try this region thing again here and see if that'll work. 1 second. So patience is a virtue. Okay. Trying to see if that'll work. 1 sec. Where did it go? It looks like it's sharing that part of my monitor. So let me just, yeah, it's a little odd, but let's try it. So basically, let me pull up this special that we have right now. It's our credit spread boot camp, and the credit spread boot camp's been really popular. It's something where for you, and let's just open a new window here. Credit spread boot camp. BigTrends.com/credit spread boot camp. So, and again, I go a little slower in the boot camps because I know I've got a little more time with folks. So these are between an hour and a half in session length, and I'm going to just shrink it up into this little window here. So hopefully you'll be able to see it for just a moment. Bear with me. Okay, there we go. So, what I've set up for you here, this was something that people paid a lot more money for to attend live, but now it's available to you for instant on-demand access. If you go to that link, bigtrends.com/credit spread bootcamp, what it is it's my credit spread bootcamp. It's 3 different unique sessions, and you see it down. You see the credit spread essentials, so you learn all the ins and outs of credit spreads. I know I had to kind of fly through them to get onto the market scanning that I know everybody wanted to soak in here. And then it gets into the trading lessons, as I call it, all the kind of like unique ins and outs of credit spreads. And then it goes into iron condors, which is basically 2 different credit spreads paired together. So when you hear that term, it scares a lot of people away, but iron condors is a really simple term to understand. So the idea here is, you see over here, this is lifetime access, okay? So you get lifetime access to the credit spread bootcamp, and all of that credit spread bootcamp alone here today, you're saving a huge amount. It would just be $195. So you're getting like equivalent of 5 hours of content. You also get dedicated email access to me and my fellow credit spread analyst, Moby Waller, who is a former CBOE market maker, key market maker perspectives and things to look for when you're doing premium selling strategies. And it's been uncannily good. You know, it's one of those where, you know, again, I didn't get to get through all of the slides I want to share with you, but real quick, just to show you some of the types of success that we've had on that. See if it'll share that real quick with you. Let's see here, trying to shrink it down so you can see that. You know, very nice results. Again, past performance doesn't guarantee future success, but in a nutshell, you can see it's had some really nice winners there in the Rapid Options Income portfolio. This is just going back into, you know, week after week after week of trades. You will occasionally get the losing trade. That's going to happen. You know, sometimes the losers will be bigger than the winners because against you and you got to manage your way out of them. Our goal, though, is to not take a total loss, to rather say, look, let's take a partial loss. We can make it up over the next trade or two, and that this system tends to win 80% of the time or more, okay? So that's a big plus on that. So what you do on this to get started, folks, is you go to that Credit Spread Bootcamp page, hit the Add to Cart orange button there, and what you'll see is that it gives you two options. One is just the Credit Spread Bootcamp by itself. It's just $195, and you can just fill out your information down below. And, you know, do mention, for those that are picking this up, our rule sheet. So just type in Bigelow there. I'm making this up on the fly, but basically if you type in Bigelow there, I'm going to, you know, we already know you're coming to us from Steve's room here, but I'm going to also want to give you a special little bonus on %R. It'll really help you understand those rules for buying and selling, when to get in, when to get out on a special rule sheet. But bottom line is you can do that. Now the other thing I didn't mention is if you like what we're doing here and would like to know even more, there's two other boot camps that you can actually add in and get a super special for the entire package. My weekly options boot camp and my swing trading boot camp. These are another 3 sessions each. So that's a total of 9 sessions when you add that little button there, and you get all sessions. If you add the 3 boot camps together, 9 sessions, $395. So it's like buying 2 of them and getting the 3rd one at no additional charge. So if you want to know what's in each of those, you can go to each of these little pages on the Credit Spread Bootcamp page. Hit the one that says Swing Trading on the tab, and it'll walk you through how it does more on the scans, more on the filters, walking you through how to manage the trades, capital allocation, trading rules, case studies for what works and what doesn't. You know, so we walk through that. And then Weekly Options Bootcamp goes through scans as well, but then it also goes through what I was alluding to before about option charts. I think the option charts become more and more important as you get. So we watch option charts very, very closely and then focus on how you can make sure you're getting executed on these trades. Let me come back and see if there's any other questions I need to pick up. But remember, go to bigtrends.com/credit spread bootcamp. That'll get you started either for just the credit spreads. If you want regular weekly income strategies, start with the boot camp on credit spreads. If you want income strategies, then you can add both the growth and the income pieces in there as well. Okay, let me go back here for a second and see what I've missed. Go back and see where, there's the questions box. Thanks for being patient with me with my one laptop limitation today. Okay. You know, I know there were some issues on the playback earlier, so basically, hopefully, that will be something that you don't have an issue with there, Brock, we're using. So when we're talking credit spreads, what we're talking about, Henrik, is not trying to hit home runs. Because when you try to hit home runs, you also have a lot of strikeouts, and we don't want that. We're going for more consistency. Typically shooting for about 80% win percentage, and again, there's times where that's more and there's times where that's less. I've seen it go to 90+% winners, and I've seen it go down under 70% winners. But it's always had, in any reasonable multi-month look-back period has had, you know, a majority of trades that are winning, and then you just have to manage the rest of the trades when they're not doing what you want it to do. Mike says, do we look at the implied volatility percentile? We watch implied volatility, Mike. It's probably more critical for options buyers, or if you're doing like a debit spread. Here with credit spreads, since we're selling one that's got a certain implied, usually the one we buy has also a similar implied. So they kind of average each other out. B Meta says, can I summarize the steps for my scanning secrets? Start with %R, B. %R is the first guide. I always say if I was stranded on a desert island, %R is my guide. You want to make sure that you use that appropriately. Chris, by the way, my lead consultant, he's in with us, Chris Sarah. Appreciate him answering questions while I was having some of my technical challenges on my computer here. But the bottom line is that he's standing by where you can reach him tomorrow actually too through our 800 Big Trends line. Like I said, mention Bigelow or Steve's name, and then basically we'll also get you those %R rules for how to get in, how to get out with specific graph. Here's where you buy, here's where you sell. That's a really nice extra bonus on that rule sheet to really help you understand how to find these buy and sell points with a really clean indicator like %R. After %RB, I then go into the acceleration and Bollinger Bands, looking at that support or resistance, or if we're in a strong trend, if we're away from those key support and resistance lines. And then I fine-tune it with tools like CCI and the DMI ADX lines as well. Okay. Yes, I created acceleration bands. So that's, you know, I looked at a lot of other bands, Bollingers, Keltners, and the like. But acceleration bands is actually what allowed me to start BigTrends.com because I was able to do so well in the mid to late 90s. And more importantly, after I started it in late 99, November 99, I actually got out of a lot of my tech stocks in the early 2000s. Even when everybody else thought Y2K was over and, whew, they thought we can breathe a sigh of relief, I said, watch out. I actually was featured in Barron's in September 2000 saying, this is unlike anything I've ever seen where people are buying the dip in tech stocks like it's a golden opportunity. Guess what? It was the start of a major bear market that led to a 2-year down for techs and the market as a whole. So very important to assess not only the trend, but also how people are reacting to the trend. Okay, you can definitely contact Chris there, Nancy, for other information about platforms like Thinkorswim. We do have toolkits not just for TradeStation, but also for Thinkorswim and Metastock currently. That is Larry Williams' indicator % range there. So yes, I tweaked it. So Larry gets full credit for creating that. I just tweaked it based on testing. All my data is driven by testing. So yes, you can see it under Williams % R rather than just %R. Okay, it looks like Chris answered a lot of these other questions. So, but the key secret is you've got to have the right technology, or you've got to be working with somebody who's using technology like this to really take advantage of it. Call us at 800 Big Trends if you have questions, or go to that link that Chris posted in the chat box, bigtrends.com/credit spread bootcamp, all one word there. And these are educational, Rick, as well. Yes, they're not just the recommendations. It's not just a black box. We're always training about why we did the trade with chart examples, marking them up, telling you this is what we like, this is what we did, and here was our stop. Here's why this worked. Here's why this didn't. So we don't just talk about winners either. We talk about all sides, winners, losers, and draws, and making sure you're always learning from the process. We don't want to just give you fish. We want to help teach you how to trade for a lifetime. So give us a call if you have questions at 800 Big Trends. Go to that link, bigtrends.com/credit spread bootcamp. I want to thank Steve and Becky and all the team there at Candlestick Forum for their patience and me going a little long tonight. And always a pleasure to be with the Candlestick Forum community. Take care, everybody. Trade them well, and let us know if you have any questions. I appreciate your time tonight as well. And look forward to working with a number of you through the boot camp and other tools at Big Trends down the line. Take care, and have a good night. I'll hand it back over to Steve or his team to wrap it up.
Thank you, Price. Everybody, the reason Price has been around so long and so successful is the information he is putting out to people is what he's developed over the years that have worked very successfully. So take a look at it. If this is something that will apply to you or you want steady income, Price is the person to go to as far as these spreads. Price, thank you. Chris, thank you. Everybody have a good evening. We'll see you in the chat rooms.